Presentations today are summary in nature. We cannot possibly cover the myriad details in the time allotted. Much of this material is from federal legislation or pronouncements that are just days old and are the subject of developing federal interpretation and regulation. While each of the presenters is a lawyer, neither the verbal nor the written presentations and responses are intended as legal advice. If specific legal issues arise with respect to any of the summary information presented today, we encourage you to consult your own legal counsel. Recent federal tax relief for the economic hardships created by COVID-19 has come from the Department of the Treasury by way of IRS notice and from the Congress and the President under the provisions of recently enacted legislation. Specifically, the Internal Revenue Service recently extended filing and payment deadlines for the 2019 tax year. The Family First Coronavirus Response Act has provided businesses with a tax credit against mandated sick leave and family leave payments to employees. And the CARES Act has provided considerable tax relief to both individual and business taxpayers. In its Notice 2020-18, the IRS recently announced changes in the filing and payment deadlines for tax returns and tax payments related to the 2019 tax year. Returns and tax payments that were due April 15th are now due July 15th. No penalty or interest will be assessed for the period between April 15th and July 15th. In addition to these extensions, the contribution deadlines for individual retirement accounts and other tax-favored plans have been extended to July 15th. The filing and payment extensions do not apply to the filing dates for payroll tax returns. And as of this date, no extension has been announced for second quarter estimated payments, which are due on June 15th. The extensions of time are applicable to individuals, trusts, partnerships, and other entities with a federal income tax return or payment due on April 15th, 2020. The state of Arizona has also made similar extensions for filing Arizona income tax returns and making payment of Arizona income taxes due on April 15th. In an effort to help employees negatively impacted by COVID-19, Congress recently enacted the Families First Coronavirus Response Act, which I will refer to as the Families First Act. This legislation takes a two-pronged approach to employee hardships by requiring employers to provide both sick leave and family leave payments to employees caught in the COVID-19 storm. Employees who are unable to work or telework due to COVID-19 reasons are entitled up to 80 hours of paid sick leave and up to 10 weeks of family care leave. To offset this burden on employers, the government has provided a fully refundable credit against payroll taxes. The details of the relief provided have already been tackled by the Department of Treasury in IRS Notice 2020-57. Additionally, the IRS has given detailed responses to frequently asked questions on its website, and the Department of Labor just issued guidance concerning the Families First Act on April 1st. The Families First Act applies to all employees with fewer than 500 employees. Healthcare workers and emergency responders can be exempted from coverage, as well as employees of employers with fewer than 50 workers. Employers are required to notify employees of their rights under the Family First Act, and employees must apply for the paid leave in writing. The Families First Act requires employers to pay family leave to employees who are unable to work or telework due to a need to leave to care for a child under 18 because the school or place of care has been closed, or the child care provider is unavailable due to a public health emergency related to COVID-19. The family leave payments are payable for up to 10 weeks. The first 10 days of the employee's absence may be exempted from the family leave requirements, but the employee may choose to use paid sick leave payable under the Families First Act or any accrued paid time off otherwise available to the employee. The amount of leave payable per day is calculated based on 2/3 of the greater of the employee's regular rate of pay or the minimum wage. Employers may claim a fully refundable tax credit for up to 100% of the qualified family leave payments, plus allocable health plan expense and the employer's portion of Medicare tax. The credit for the family leave payments is capped at $200 for each day an employee receives qualified family leave wages, with a maximum $10,000 per employee. Allocable health plan expenses are amounts paid or incurred by an employer to provide and maintain a group health plan, but only to the extent the amounts paid are excludable from the employee's income under federal tax law. The Families First Act also requires employers to pay employees for sick leave under the 6 different scenarios described in this slide. For full-time employees, the required duration is up to 80 hours. For part-time employees, the duration is equal to the average hours worked over a 2-week period. For employees in situations 1 to 3, the amount of pay is based on the greater of the regular rate of pay or the minimum wage, capped at $510 per day. For employees in situations 4 through 6, the amount of pay is based on the greater of 2/3 of the regular rate of pay or the minimum wage, capped at $200 per day. Employers may claim a fully refundable tax credit for up to 100% of the qualified sick leave payments, plus allocable health plan expense and the employer's portion of Medicare tax. The credits are available for qualified sick leave and family leave wages paid during the period beginning April 1, 2020 and ending December 31, 2020. An employer claims the credit on the employer's quarterly payroll tax filings. Employers can fund qualified family and sick leave payments and applicable qualified health plan expenses and employer's portion of Medicare by reducing the amount of payroll tax that would otherwise be deposited with the government, or by requesting an advance from the IRS using Form 7200, Advance of Employer Credits due to COVID-19. Employers must keep records and documentation relating to and supporting each employee's leave. The Coronavirus Aid, Relief, and Economic Security Act, or CARES Act, represents significant bipartisan efforts to get cash into the hands of American taxpayers, both individuals and businesses. The act aims to stabilize the economy and provide broad relief. Major relief to individuals comes in the form of rebates, which Carson will discuss in a few minutes, and a few other provisions dealing with qualified plans and charitable contributions. Under current law, taking distributions from an individual retirement account or qualified plan before age 59.5 subjects the participant to a 10% early withdrawal penalty. The CARES Act provides relief from this penalty tax for COVID-19 related distributions. The amount of the penalty waiver is limited to the first $100,000 of COVID-19 distributions received in a tax year. Taxpayers that receive a coronavirus-related distribution from an IRA or qualified plan have 3 years instead of the normal 60 days to repay the distribution. If a taxpayer chooses not to repay the distribution, the taxpayer can elect to include the distributive income ratably over 3 years, starting with the year of distribution. In addition to favorable repayment provisions, the CARES Act also waives the normal 20% withholding requirement for distributions from an IRA or qualified plans. The CARES Act also modifies the rules for loans from qualified plans. Normally, a plan participant is limited to borrowing the lesser of 50% of their account balance, or $50,000. The CARES Act opens a 180-day window, starting with the date of enactment, that raises the dollar amount to $100,000 and eliminates the 1/2 account balance limit. There is no requirement that the loan be coronavirus related. Employees are also given an additional 1 year to make existing loan payments due between now and December 31, 2020. The Act also provides for a 1-year waiver of required minimum distributions from defined contribution plans and IRAs. It also provides a number of charitable giving incentives to both individuals and corporations, including the deduction of qualified contributions up to 100% of 2020 AGI for individuals and up to 25% of 2020 taxable income for corporations. To qualify, the contribution must be in cash and must be made to a public charity. Certain ordering rules govern the deduction of qualifying and non-qualifying deductions. The CARES Act contains significant federal income tax relief for American businesses, beginning with a credit against employment taxes up to 50% of qualified wages for each qualified employee. The credit is available to all employers of any size, including tax-exempt organizations. Qualified wages are generally any wages paid to employees in calendar 2020 during shutdowns caused by COVID-19, or in a period beginning with the quarter in which the employer experienced a 50% or greater reduction in gross receipts in that quarter compared to the prior year, and ending in the quarter in which the employer had gross receipts greater than 80% in the same quarter of the prior year. Qualified wages cannot include any wages considered under the Families First Act. Additionally, the credit is not available to small businesses who take loans under the CARES Act Payroll Protection Program. The IRS has recently provided further guidance about this credit in IRS Notice 2020-62. Next on the list of business tax relief under the CARES Act is a form of tax deferral. The Act permits employers to defer payment of the employer's matching portion of FICA. The deferral may be paid in 2 installments, one by December 31, 2020, and the other by December 31, 2021. The CARES Act also modifies current rules dealing with net operating losses, or NOLs. Section 172A of the Internal Revenue Code limits the amount of net operating losses a corporation may deduct in a single tax year to the lesser of the available NOL carryover, or 80% of the taxpayer's pre-NOL deduction taxable income. The Act delays application of this 80% rule until years beginning after December 31, 2020. The Act also reinstates NOL carrybacks, providing that losses arising in the 2018, 2019, and 2020 tax years may be carried back to each of the prior 5 taxable years. Finally, the Act appears to allow individuals to carry back NOLs for 5 years as well. This could result in considerable refunds of taxes paid in prior years. Beginning in 2018, non-corporate taxpayers became subject to a new excess business loss limitation. This provision prevented taxpayers with significant business losses from claiming losses that exceeded the threshold amount, $250,000 for most taxpayers, $500,000 for joint filers. The CARES Act defers retroactively the effective date of this provision to tax years beginning after December 31, 2020, and makes certain technical changes to the definition of excess business loss, which are favorable to taxpayers. This change allows taxpayers to file amended returns for 2018 to claim losses and request a refund. The Act accelerates the payment of alternative minimum tax credit refunds to corporations. Corporations with AMT carryforwards may be able to claim tax refunds under these new rules. Finally, the Act makes 3 significant changes to the broadly applicable business interest deduction limitation rules under Section 163J. These changes will prevent many businesses to deduct a greater amount of interest expense.